morning, and thank you for joining Thompson Hine's weekly coffee chat series. I'm Mike Weibel, a partner in Thompson Hine's Investment Management Practice Group. This is the 8th webinar in our weekly coffee chat series. These short and practical discussions focus on a variety of developments that impact the financial services industry. Joining me on the phone today is Les Abramovitz. Les is a senior director with Foresight. Today's session is the third and final chat on the recent revisions to the investment advisor advertising rules. In the first session, Craig Foster and Brian Doyle Wenger gave us an overview of the amended rules. Craig was back last week with our colleague Josh Hinderleiter and Jackie Hummel from Hardin Compliance to discuss the rules treatment of testimonials and endorsements and the amended books and records requirements. Today, Les and I will explore performance advertising, including the use, including the use of predecessor and hypothetical performance, along with some practical compliance considerations. If you have any questions or comments during today's program, we encourage you to join the discussion by using the Q&A box at the top of your control panel. We'll address your comments as we move through the discussion, and we'll try to leave some time at the end for questions. If we don't get to your question, don't worry. We'll follow up after the program. All right, just to recap for any first-time listeners, last December, the SEC adopted amendments to modernize the rules under the Investment Advisors Act that govern investment advisor advertisements and payments to solicitors. The amendments created a single marketing rule that replaces the current advertising and cash solicitation rules. The final rule is designed to comprehensively and efficiently regulate marketing communications by investment advisors and is intended to reflect changes in technology and industry practices since the existing rules were adopted. The rule takes effect on May 4th of this year and provides for an 18-month transition period. So on the first session, Craig and Brian discussed the general prohibitions under the rule. Those prohibitions also apply to performance advertising, but performance advertising also is subject to other specific requirements and restrictions, and those are what we'll look at today. So consistent with the SEC's long-standing position, the new rule prohibits an advisor from showing gross performance in an advertisement unless the advertisement also shows net performance. The net performance must be presented with equal prominence and calculated in the same manner as the gross performance. This means that both gross performance and net performance must be calculated over the same time period using the same returns and the same methodology. And this applies to advertisements that are directed to both retail and institutional clients. The rule does not dictate disclosure requirements for net and gross performance presentations. Instead, advisors need to comply with the rule's principle-based general prohibitions. So Les, given that the rule lacks specific disclosure requirements, what factors, assumptions, conditions should the advisor consider when putting together performance advertising?
Thanks, Mike. Before I address that, I just want to make sure folks know to keep in mind that the new rule formally adopts some of the performance advertising guidance we received previously in no-action letters like Clover Capital. So if you're like me and enjoy reading no-action letters because you don't have a life, much of this performance advertising information will seem familiar. The SEC will be withdrawing many no-action letters because they're incorporated in the new rule. Keep in mind also that the SEC continues to believe that performance advertising raises special concerns that warrant additional requirements and restrictions. In particular, the presentation of performance could lead reasonable investors to unwarranted assumptions, and that makes the advertisement misleading. And because of those special concerns, the SEC wants you to flag in your Form ADV that you're using performance advertising. Advisors should evaluate the specific facts and circumstances that may be relevant to investors, including the assumptions, factors, and conditions that contributed to the performance and include appropriate disclosures. So some of those disclosures may include material conditions, objectives, and investment strategies used to obtain the results portrayed, whether and to what extent the results portrayed reflect the reinvestment of dividends and other earnings, the impact of material market or economic conditions on the results, the possibility of loss, and material facts relevant to the comparison made to the results of an index or other benchmark. So just so you know, what you want to do is avoid a situation where you're not disclosing everything. A statement may be misleading if the advisor neglects to mention that an index or benchmark consisting of a substantially comparative portfolio of securities experienced significantly higher returns during the same period. So to avoid making a misleading statement, the advisor would need to include the relevant index or benchmark or otherwise disclose that the advisor's performance, even if it was positive, significantly underperformed the market. So each situation in each form of performance advertising will require unique disclosures. So there won't necessarily be boilerplate disclosures. So I think we can move on from there, Mike.
Yeah, and I think we're going to get into that a little bit later too. We talk about the time periods that are required to disclose, and when you may have to. Time periods used in performance advertising, and when you may need to use different time periods based on significant market conditions that may have affected performance. So thanks for mentioning that, Les. We're going to talk a little bit about gross performance right now. The rule defines gross performance to mean performance of a portfolio. And just as an aside, when the SEC in the rule talks about a portfolio, they mean a group of investments that are managed by the investment advisor, and it can include separately managed accounts, it can include private funds. These advertising rules do not apply to mutual funds, which are registered funds, but they do apply to private funds. So as I was saying, the rule defines gross performance to mean performance results of a portfolio before the deduction of all fees and expenses a client or an investor in a private fund paid or would have paid in connection with the advisor's advisory services. Again, as Les mentioned, there is no specific method of calculating gross performance, nor is there a specific disclosure that's required in connection with calculations of gross performance. So Les, that gets me sort of a repeat of the first question. What type of disclosures would you recommend advisors make regarding how gross performance is calculated?
Okay, and just one additional point that I need to make. Over the years, I've made many advisors cry because they wanted to present their returns gross of fees. And obviously, now it's even clearer that you have to present both gross of fees and net of fees. Many advisors over the years determined that their returns look pretty sad once you reduce them by advisory fees. And so, as an aside, it's important to note that not every client will make their decision on the basis of returns. So before you advertise performance, you might want to think, am I really going to impress these people, or should I rely on my background and other factors to convince them they should be a client? But getting to your question, one of the things I think is important to disclose is when you apply the fee. I see many advisors who apply the fee when they're doing performance advertising in a manner that's contradictory from their Form ADV. For instance, if you disclose, if you apply a fee after the quarter, then that's misleading if you charge fees in advance. So always it must be consistent with your Form ADV. And once again, we're looking at facts and circumstances, which seems like a cop-out to determine what disclosures are necessary. But let's take the example of cash flows. If you're taking that into account as part of your performance advertising, you're going to need to fully disclose that, or if you don't, if those returns don't reflect cash flow and other relevant factors. And once again, there are no magic words, so you certainly would need disclosures, for instance, that all investment strategies have the potential for profit or loss. If you take large withdrawals or make huge deposits, it's going to cause a discrepancy in the returns. And also, I always want to assure investors that there's no guarantee that they'll match or outperform any particular benchmark.
And I suppose you're also going to want to disclose whether or not transaction fees are included in gross performance or not.
Definitely.
All right, so let's turn to net performance then. So the rule defines net performance as performance results after the deduction of all fees and expenses that an investor or client paid or would pay. And it specifically mentions advisory fees paid to underlying investment vehicles such as mutual funds or private funds, and payments by the advisor for which it receives reimbursement from the client or the investor. The advisor is not required to include custody fees paid to a bank or third party in its net performance calculations. But other than those fees that I just mentioned, the SEC really doesn't prescribe any particular method for calculating net performance. Les, you want to talk about some of the fees that, in your view, should be included in calculating net performance? I think the SEC does discuss some of them in the adopting release.
Right. One of the most important ones they mention is performance-based fees and performance allocations that a client or investor has paid or would have paid in connection with the investment advisory services. With respect to the administrative fees and expenses, whether a client or investor pays them in connection with the investment advisor services and therefore must be deducted depends upon facts and circumstances again. And you'll see if you read the release, and many of you I'm sure have, the term facts and circumstances is listed a number of times. So it sounds like a cop-out and sounds like something lawyers use to avoid giving you a concrete answer, but that happens. One other precaution I want to throw out there as it relates to net performance. It's not just charts and graphs that show performance. For instance, I have seen so many ads where the advisor states that he or she has outperformed the market or all of their clients made money. That would be misleading under the general prohibitions if that isn't true after you've deducted advisory fees. So your net performance must support some of those allegations and statements that you're making to prospective clients. So make sure that you can support them, even though you may not think you're engaging in performance advertising. You are referencing performance at various times in your advertisements.
Yeah, and Les, I think you make a really good point about facts and circumstances, because the SEC, in the adopting release, really makes it clear that they didn't adopt a very prescriptive rule with specific required disclosures, but a rule based on general principles and the general prohibitions, so they can give advisors flexibility to advertise. But as I think you said, that gives some advisors some rope to hang themselves with if they're not very careful in analyzing their analyzing advertisements for false and misleading or misleading by implication statements or omissions. Hey, one question that often comes up is, do capital gains taxes that are paid outside of the portfolio need to be included in net performance?
Well, the SEC has said that capital gains paid outside of the portfolio are not fees and expenses that a client or investor has paid or would have paid in connection with the advisory services. Therefore, you're not required to deduct those expenses when you calculate net performance.
Okay, great. Let's go to model fees, because sometimes an advisor wants to use model fees rather than actual fees, and the rule does permit the use of model fees rather than actual fees in calculating net performance, as long as the performance figure is no higher than if actual fees were deducted, and there are some other conditions that are required to be complied with. Les, can you walk us through when an advisor might want to use model fees and the conditions the rule places on use of model fees?
Okay. The thing with model fees is it should make it easier for the advisor to apply the model fee. And once again, you have to apply them in the manner that's consistent with your Form ADV. But just so we're clear, you have to apply a model fee that reflects either the highest fee that was charged historically or the highest potential fee that it will charge investors or clients receiving the particular advertisement. One thing I found very interesting in the adopting release, and I do mean one thing, advisors must apply the model fee to non-fee paying portfolios to calculate the net returns. Otherwise, this presentation could mislead investors into believing their returns would be as high as non-fee paying clients. So over the years, I've had advisors, especially those who were starting out, who weren't charging fees to friends and relatives. And if you based a model fee on that, you would run into a situation where a prospective client might think their returns would probably be a percent higher than they actually were.
Yeah. Okay. Hey, Les, before we move on, I just don't want to forget, we received a question about a comment you made about Form ADV. And the question was that this person filled out the ADV yesterday, but did not notice any questions about whether the firm used performance advertising. Is that something that's going to show up in the next version of Form ADV that's not yet out, or is there some place that he should be looking?
I'm told that it's in Item 5. There's a new Item 5 that addresses that issue. I don't know if they've officially revised the form yet, but that when it arises, that's where you'll look, Item 5.
Okay, great. All right, so earlier, Les, you mentioned the time periods. We had a little discussion about the time periods that have to be used when calculating gross and net performance. Can you talk a little bit more about those time periods and how they should be used?
Okay, by requiring performance returns for prescribed time frames, the SEC is trying to keep advisors from cherry-picking the time periods where the RIA's results look better than they actually are. Presenting performance returns over a short period of time, such as 2 months, or over inconsistent periods of time, may result in performance portrayals that don't reflect the advisor's general results and aren't fair and balanced. I once dealt with an advisor who wanted to engage in performance advertising after 1 month in the business. Needless to say, he had a good month coming out of the gate, but that wasn't appropriate for performance advertising. The rule requires that performance results for both retail and institutional clients be shown for 1, 5, and 10-year periods, ending on a date no less than the most recent calendar year end. If a portfolio did not exist for a particular period, then the life of the portfolio must be shown. And this applies to both gross and net performance, but doesn't apply to private fund performance.
Right, and it doesn't apply to hypothetical performance either, I believe.
Right.
And then, but sometimes, advisor may be required to show more recent performance if the results if by showing calendar year-end performance, it may be misleading because a significant event may have occurred after the calendar year end. So you may be required to show more recent quarter end performance in order to make your advertising misleading. I'm sorry, advertising not misleading. The adopting release also makes clear that an advisor can show other time periods, for instance, 3 years or 7 years, as long as the rule is otherwise complied with.
Well,
right,
you make a good point, Mike. Let's say the market plummets in 2021, and the advisor continues to use performance returns from the end of 2020. That may be misleading. It's always been the case that stale content can be misleading. I see websites with performance returns quite often. An examiner may question whether you have deliberately violated the new marketing rule or you never got around to updating your website, which is often the case.
Mm-hmm. And I think that you make a good point about stale performance, because stale information of any sort, because I think a lot of people focus on misleading statements as a statement that has been where they said something that was misleading, but omitting information or failing to update information or is just as misleading as an actual statement that's misleading.
Right.
So we're going to turn to portability of performance now. And so, an investment advisor may want to advertise the performance results of portfolios that they managed before, for instance, spinning off into a new firm, or a portfolio management team leaves one advisory firm and joins another advisory firm, or begins its own firm and wants to advertise the performance it achieved at the prior firm. In the advertising rule covers, as did a string of no action letters, predecessor performance. Les, can you talk about how predecessor performance is handled by the rule?
Okay. Basically, there are 4 requirements if you want to use the performance from prior firm. The person or persons primarily responsible for achieving the prior performance results manage accounts at the advertising advisor. The accounts managed at the predecessor investment advisor are sufficiently similar to the accounts managed at the advisor who is advertising now. All accounts that were managed in a substantially similar manner are advertised, unless the exclusion of such account would not result in materially higher performance, and the exclusion of the account doesn't change the presentation of any applicable periods required by the marketing rule. And the 4th is the advertisement clearly and prominently includes all relevant disclosures, including the fact that the performance results were from accounts managed at another entity.
And a lot of times, in those situations where a sole portfolio manager managed the account and left, that's a pretty easy one. That they determine that they're primarily responsible for achieving the prior performance. But a lot of times you have teams or individuals who are responsible for sleeves of a portfolio. How should an advisor go about determining who's primarily responsible for achieving the results?
Okay. A person or group of persons is primarily responsible for achieving prior performance if the person makes or the group makes investment decisions, where more than one person is involved in making investment decisions, advisors should consider the authority and an influence that each person had in making decisions. So if there was a low-level advisor on that team who really had no input, that advisor shouldn't be taking those returns elsewhere. The primarily responsible requirement is substantially identical to the existing guidance we have now in the Horizon No Action Letter, which generally turns on the role that the individual or individuals played in producing the performance. In other words, the extent of their decision-making authority. So where there is more than one person who was responsible for the performance, the substantial identity of the group for achieving the prior performance must be looked at.
All right, and so that leads us to the other question on, how do you substantiate that performance that you received in the prior firm? Les, as a compliance professional, I'm sure you have lots of recommendations on documentation.
Right. The problem is many of these records from prior firms aren't available. So the SEC said in the adopting release for the new rule, the advisor must have a reasonable basis for believing that it will be able to substantiate, upon demand by the Commission, all material statements of fact contained in an advertisement. So you need to be able to produce books and records to show how the performance was calculated, and hopefully when you actually have an exam, you won't run into a situation where you can't get those records. But you have to have a reasonable belief that you can get them. But you also, with any kind of performance advertising, need accounts, books and records, internal working papers to demonstrate your calculations. You also need to have communications related to predecessor performance. So any emails or any communication involving how you arrived at these prior performance, you're going to need to keep.
And so I guess depending on the circumstances of your departure from a prior organization may impact the ability to substantiate the prior performance.
Right, especially if you left on bad terms.
Right, right. All right, we're going to change gears a little bit and turn to hypothetical performance, which is defined in the rule as performance results that were not actually achieved at any portfolio by the investment advisor. The rule explicitly includes model performance, back-tested performance, and targeted and projected performance, but it doesn't limit necessarily hypothetical performance just to those three. The SEC has always been skeptical of hypothetical performance because of its potentially misleading nature. The new rule permits hypothetical performance but requires the advisor satisfy certain conditions, including the requirement to adopt and implement procedures and policies reasonably designed to ensure that the hypothetical performance information is relevant to the likely financial situation and investment objectives of the intended audience of the advertisement. The rule also requires that the advisor provides sufficient information to enable the intended audience to understand the criteria used and the assumptions made in calculating hypothetical performance and the risks and limitations of the information. I know that's a lot we just went through, but Les, can you talk about how an investment advisor determines that hypothetical performance is relevant to the likely financial situation and investment objectives of the audience?
Sure. First of all, keep in mind that the books and records rule now requires you to keep records of who the intended audience is. It's one way they'll be able to evaluate whether you complied. So an advisor's past experiences with particular types of investors could and should lead the advisor to design reasonable policies and procedures that distinguish among investor types and whether hypothetical performance is relevant to their financial situation and investment objectives. These policies and procedures should distinguish investment advisor types on the basis of criteria such as their previous investments, their net worth, their investment experience, whether they're a qualified purchaser or qualified client, or whether the intended audience includes only natural persons or whether it's institutions. So you have to make sure that the hypothetical performance is relevant to their likely financial situation. Therefore, you generally would not be able to include hypothetical performance in advertisements directed to a mass audience or intended for general circulation, because you as the advisor would be unable to form any expectations about their what's relevant to them. And lastly, new advisors who don't have prior client experiences can inform their determination of the intended audience by looking at resources such as questionnaires, surveys, questionnaires that they've gathered from potential investors or academic research. So new advisors will have some documentation they can fall back on.
And I think you made a good point, Les. I think it's pretty clear that the Commission expects hypothetical performance really to only be used with highly sophisticated investors that have, that can independently analyze the information and have expertise, the financial expertise to understand the risks of and limitations of the performance presentation. Like you said, not the mass audience or the general circulation, which is consistent with the SEC's position that they've had for many, many years. Finally, we're going to turn to interactive analysis tools, which the Commission in the rule explicitly accepts from the definition of hypothetical performance, and it allows the use of interactive analysis tools, which they say are tools that prospective clients can use to provide simulations or statistical analysis of the likelihood of an investment outcome based on certain investments or strategies or styles, and it will help the client determine the potential risks and returns of their investment choices. FINRA has historically not considered interactive analysis tools to be hypothetical information, and as I said, the SEC followed that same approach, and does allow their use as long as certain conditions are complied with, including describing the methodology and the criteria used, explaining that the results could vary over time, describing the universe of investments that are analyzed, and disclosing that the outcomes are simply hypothetical. Les, what types of disclosures, maybe I went over some of them right there, but there might be more, but what types of disclosures should advisors use when they're using or offering an interactive analysis tool?
Right. My concern would always be, does the investor or does the prospective client have high expectations that can't be met by the advisor? So I would want to include disclosures like projections are based on assumptions that may not come to pass. And I would also be looking at making sure every person involved in that interactive analysis tool understands these are hypothetical results. Too many times an advisor may want to win the client over, and if those assumptions they're using are unrealistic, not only will it blow back with a bad Yelp review someday, but it will also blow back in terms of potential compliance issues because you haven't come anywhere close to the returns that were projected by the interactive investment analysis tools.
So you really want to keep in mind those general prohibitions on false and misleading statements or anything you omit to explain about the interactive tool and the results that it can produce.
Right, and I believe examiners will be looking at the credibility of the investment analysis tool, and once again, so many times prospects and investors don't realize it's generating hypothetical information. So at the risk of saying hypothetical too many times in your disclosures, make sure people know that there are no guarantees.
All right, thank you. That concludes today's chat. I want to thank everybody who is still attending for hanging in with us. I apologize for those technical difficulties we had in the delayed start of today's coffee chat. If you have any other comments, please enter them in the Q&A box at the top of your screen. Our next coffee chat will be held on Wednesday, March 24th. We're going to change gears a bit, and my colleagues Andy Davala and Ed Redder will discuss the implications of recent ERISA guidance on ESG investing. To register for future coffee chat discussions, visit the events page on the Thompson Hine website. To review past coffee chat recordings, you can visit the Thompson Hine YouTube channel. Thank you all for your interest and attending today's program, and thank you, Les, for sharing your insights. And Les, happy St. Patrick's Day. And
thank you.
When the webinar ends, you'll be prompted to take a survey providing feedback. This survey is important and will help us to continue to tailor our programs to your needs. Thanks again. Enjoy the rest of your day and stay well. Bye, everyone.